Is SOFR, and how has it gained so much of domination in the interbank money markets as well as in the bond markets? Let's learn more. I'm your learning partner Sushila Hariharan, and if you're interested in a career in capital markets, trade life cycle, investment banking, and hedge funds, do subscribe to my YouTube channel where we have uploaded more than 300 videos on different topics on on these lines. We will talk today about SOFR, Secured Overnight Financing Rate, which replaced LIBOR about 4 years ago, which was the London Interbank offer rate, acting as a benchmark rate for interest rates. Have you heard of S&P 500? Have you heard of Nikkei 225 in the Japanese markets? Have you heard of Nifty 50 in the Indian equity markets? Then the bond markets and the money markets also need a benchmark of their own, and that benchmark in dollar terms is defined as SOFR, Secured Overnight Financing Rate. Secured means it is a collateralized trade. So these are not naked lending transactions, okay? They're collateralized trade. That means there is a repo transaction in order for the counterparties to trade in government securities with each other. Overnight means it's for 1 day. That is, the lender lends money, the borrower repays principal plus interest on the very next day. That is, it's a T+1 kind of a transaction. If the borrowing is for anything more than 1 day, then we have to calculate the terms and conditions of the duration of more than 1 day. But SOFR is an interest rate benchmark only for overnight transactions. We have other term SOFRs that are released by CME, but that is in the United States. But in this case, we are talking only about USD SOFR, which is announced by the United States Federal Reserve Bank. The SOFR is only for overnight financing, secured overnight financing rate, right? For which currency? For USD. For different currencies like the GBP, you have SONIA, and in many other markets in the world, we have ARR, which is alternative reference rates. The whole idea is that we calculate the interest rates for the next day on the basis of the trades that are taking place today. So unlike LIBOR, which was used for almost 3 decades, that's the London Interbank offer rate, was the interest rate which was used for almost 3 decades by global markets, including the London markets, New York markets, and even in India, we use the LIBOR as a reference rate for dollar-denominated transactions, lending and borrowing transactions. But because of the LIBOR scam of 2013-14, where LIBOR was underpriced in order to show higher profits for some of the dealers in the money desk at some of the largest investment banks, the LIBOR was slowly removed as an interest rate benchmark, and in its place came SOFR. The biggest difference between LIBOR and SOFR is LIBOR is an indicative rate, right? Whereas SOFR is an actual rate of all the trades that have taken place today, which is then used by banks for trades to be concluded the next day. So since it's only overnight, the trade literally starts the next day, but the interest lock-in has been done on the basis of interest rates of the previous day. SOFR has worked so far so good in the money markets across the world, and many banks have adapted their systems, their bond products, their pricing, their valuation, their mark to market, etc., with reference to SOFR. Let's see how long this can go on, because SOFR, it's a benchmark rate. Since it's a benchmark rate, a spread is added to the benchmark rate on the basis of which the actual transaction is then concluded. So suppose you say USD SOFR plus 20 basis points, then you go back and find out what was the USD SOFR, and you add 0.20 to it, 0.20% to it, to get the actual rate of the overnight financing transaction. SOFR trades have been dominating the markets in the interbank money markets, especially in the London markets and New York markets, all of the last 3 years. They've also been used, it has also been used for valuation of interest rate swaps denominated in dollars, as well as in any other financing transaction that has been used for lending and borrowing in the case of the USD currency. We'll see how far SOFR goes, because we'll have to understand that SOFR migration was not an easy task, especially for the large book of swaps that many of the investment banks had, and therefore the migration from LIBOR to SOFR took almost 18 to 24 months. But till now, it's been working fine, seamlessly, and nothing that I have heard resembles the fact that it could have gone wrong. So let's hope this continues in the future as well. Thank you so much for watching in.